The markets are open, and with it being election week, we are expecting a lot of volatility right across the board. And today we want to focus on the REIT industry that over the last 30 days has seen take a dip pretty much across 90% of these stocks. And what we know, with the rates starting to come down, with the Fed also speaking, that historically it is a great time to consider adding these into your portfolio. As we can see, the REITs in the dark blue tend to outperform the equity market, not just in the first quarter where we can see 10% for REITs as opposed to 7% for the overall market, but when we look at quarter two as well as the next 4 quarters, REITs typically tend to be the best place to have your money stored. Now, we also know the Fed is due to speak later this week, and the expectation right across the market is to see a 20 basis point cut. That is irrespective, as we can see here, of whichever candidate does win the election. Now, we also notice this week a lot of volatility, not just for that purpose, but a lot of REITs are also reporting. In fact, Realty Income, the monthly dividend payer, is expected to announce its earnings after the bell today. So today we're looking at 6 buy the dip REIT stocks that we do believe have a great yield, great upside, as well as potential for long-term growth. Now, the first one is Prologis. This is up around 9% over the last 12 months. When we just look over the last 30 days, it is down around 5.5%. Over the last 10 years, though, this has outperformed the S&P 500, up 177%. Now trading in the lower end of the 52-week range. Double buy rating, seeking alpha in Wall Street, hold from quant, nice forward yield 3.4%, and a price to funds from operation of 20.85. Now, when we take a look at the expectation for the next 4 quarters, they're expecting growth every single one. And when we look back over the last 4 quarters, they have a 100% track record, either in line with management targets or they have outperformed. Now, FFO is anticipated to increase over the next full year, lowering that forward P to FFO to 19.4. Now, in terms of dividend safety score, and we'll look at this for each one of the 6 today, it gets 61, indicating safety. We have a double undervaluation, which we will discuss, and nice to report, in this year, February in fact, they increased the dividend by 10%. Now, it was reaffirmed just a few days ago, this safe score, and ultimately what it means is that a dividend cut for Prologis is unlikely. Now, we'll look at key metrics for each one of these REITs, essentially from the last recession, 07-09. PLD, well, they cut the dividend. They had below average growth, negative 80%. S&P during this time was negative 12, and they massively underperformed the S&P, negative 84, S&P itself, negative 55. Nice increase, as we said, this year, but also double-digit increase over the last 5 years. Important to flag, though, it is 0% over the last 20, because when we do take a look, they actually cut the dividend more than once during that recession and only recently started to increase it at this favorable rate. Hence why we get 10 years of consecutive increases, 12 years of paying a dividend without a reduction. Now, based on the forward P to AFFO, what we do notice, with the blue tunnel being the expected fair price, this company has traded throughout the last 12 months towards the middle point, in fact sometimes even below that. Right now we get that sign today, which means there is severe undervaluation for this REIT. And when we look at both dividend yield theory as well as the forward P to AFFO, this is another double undervaluation signal. The yield at 3.34 is higher than the 5-year rolling of 2.54, and also we note the forward P to FFO 25.2 below the 5-year of 28.6. However, we do have to point out it still trades higher than real estate overall at 16.3. Now, do bear in mind we are going to run these through our valuation model today, and we don't typically look at any one of these models in pure isolation. Now, if you're a regular viewer, you know we always draw your attention to free cash flow, but for REITs, a little bit more volatile, so we talk about the adjusted funds from operation, and for the payout ratio, we want below 75% for industrials. That is pretty much what we get every year, although we do notice it is expected to increase to 84% over the next 12 months, so definitely something to keep an eye on. Similar to free cash flow, for AFFO per share, we want consistent increases over the long term. Pretty much what we get with Prologis, although a small dip into 2023, but also another dip anticipated over the next 12 months. something we can consider adding a larger margin of safety for. Then we get to sales growth for REITs, 5 to 10%. Very good growth over the longer term, even though it has been very inconsistent. 1% noted on a trailing 12 month. And when we look at the AFFO per share growth, we can see historically looking very, very good, although the last full year as well as the last 12 months looking like there is some cause for concern. Nice to see though over the next 12 months anticipated to go back up to that 5%, which is a fairly respectable figure. In terms of the numerics for their top line revenue, we can see in fact more than quadrupled from 2 billion to over 8 in 2023. And like this industry as a whole, they will dilute your position, as we can see through the shares of equity. Reason for this is that they retain a little of that internally generated cash flow after paying the majority out as dividends. Some REITs will dilute your position at a much faster rate, so something to keep an eye on as we go through these REITs today. But Prologis are pretty decent. It is not very rapid, like we will come to show you with some other notable companies. ROIC 3 to 5% for REITs. Give us faith, management are able to effectively allocate their capital. What we can see here, around that point every single year, so nice and consistent, 4% on a trailing 12 month. We then notice operating efficiency with their margins increasing from 24% to 41% in 2023. Nice sign, it is typically what we define as a high quality company, increasing revenue, increasing margins. And then we get to the final metric, the net debt to EBITDA. Earnings before interest, tax, depreciation, amortization. And we want to see below 5 for this. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. And while we focus on this, it correlates to both dividend safety, balance sheet strength, and what we've noted, in fact, has been very high consistently. 5.23 in 2023, just under 6 on a trailing 12 month, and we do note it is expected to come down to around 5 over the next year, but again, not something we want to see. We ideally want to see it below 5, so something again to consider with Prologis, and now when we run it through our valuation. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value today at $132 is just the average of these two models. Typically when we do our deeper dive, we go through the inputs and outputs. Today, getting straight to it, we want to apply a margin of safety and we start off at 10%, execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, and good forward-looking data. If you believe that for PLD, well, a buy up to $119 at 15%. It isn't quite there yet, but not too far off. So for PLD, you could say it is very, very near a 15% margin of safety. And Wall Street, as we saw at the beginning of the episode, they consider this a buy. Their price target, $134, upside of 18%. Over the next 12 months. And as we do go along these stocks today, give us your thoughts below whether they are a buy, hold, or sell. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we talk about severely undervalued stocks that deserve your attention, as well as what's gone in the market in just the last few days. So click on the pinned comment below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each. The upside Wall Street do anticipate over the next 12 months. And you can also grab 22 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P. The next stock we're looking at is Realty Income. Now this is up around 23% over the last 12 months. As we can see, over the last month, it is down around 3%, but when we take a look at the 52-week range, it's down around 10% from the 52-week high. Now we get a triple buy rating right across the board, Seeking Alpha, Wall Street, as well as Quant, who aren't too far off. 4.5 would indicate a strong buy rating, so they do like this company significantly. As we said, good performance over the last 12 months. However, over the last 10 years, it is up only 26%. Remember, if you reinvest dividends, it would be higher, but it still has lagged the S&P. And what we also note, it hasn't recovered from the highs of that pre-COVID drop at $82, still a little bit away. In terms of the forward yield, remember they do pay every single month, 5.4%, and the P to FFO, 14. That is below what we just saw for Prologis. As we mentioned, this is a REIT that is reporting this week, in fact today after the market close. And over the next 4 quarters, they are expecting growth to the FFO. However, out of the last 4 quarters, they have missed 50% track record, although the more recent quarter was a beat. They also expect FFO to continue to increase year on year for December 2025, lowering the P to FFO to 13.3. Now we get a safe score at 80. We also note a double undervaluation with around an inflationary increase to their dividend over the last full year. In terms of how they formed in the last recession, well, they increased the dividend, they had above average growth, and they also marginally outperformed the S&P, negative 43%. And this is a company that historically, over the last 5 and 20 years, tend to increase that monthly dividend in line with the inflation rate. And what we can see also, they are an official dividend aristocrat, given they've been increasing those dividends for 25 years or more, paying a dividend though for the last 55 years without a reduction. Now, in terms of this valuation model, we also notice for the majority of the last year trading well below the minimum expected fair price, and we see that again at today's date. We also note when looking at both dividend yield theory as well as the P to FFO, this is significantly undervalued on both of these metrics, and we also, unlike Prologis, notice that it does trade P to FFO significantly lower than the real estate sector. Then when we take a look at their payout ratio, we can see below 90% consistently, also decreasing over the period, 74% over the next 12 months. So that is a good sign for this company, especially given it does pay every single month. We also like the consistency in the FFO year on year, quarter on quarter as well, and we notice it is expected to increase over the next 12 months. Always a good sign to see a company in this position. And we do note the AFFO per share growth, whilst inconsistent, still looking fairly solid, 4% on a trailing 12-month, 3% anticipated over the next year, and 5 to 10% at a minimum being hit every single year. Last 3 years looking good, trailing 12-month also looking very respectable. We can in fact note very large growth, more than quadrupled over the last 10 years. But as we pinpointed with Prologis, this company, Realty Income, does dilute your position at a very rapid rate. If you want to go back and just check Prologis, you can see in comparison, Realty Income's is much faster. Then we get to the ROIC between 3 to 5% year on year, although we can note it has dipped from 2020 and the last 7 years where it was sitting around the 4%. In terms of the margins, fairly flat around the 40 to 50% on a consecutive basis, 44% on a trailing 12 month, and with the net debt to EBITDA, something we flagged for Prologis, pretty much the same to say for Realty Income, 6.05, and in fact the majority of the last 10 years above that maximum 5.5. Nice to see, anticipated to come down to 5.2 over the next year, just something we need to keep an eye on and make sure they can hit that target. In terms of our intrinsic value, well, $69, and this is a company we did an in-depth review on just a few days ago, so if you want a bit more meat to all of this discussion, do check that out. 69, as we just said, current price around 59, at 10% $62, at 15% pretty much near where the current trading price is. So Realty Income monthly dividend payer, 15% MOS, 12% upside with a price target of $66 from Wall Street. Is this one you are considering to buy? Give us your thoughts below, and remember you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Realty Income or any others. Then we move on to Alexandria Real Estate, where it's up 10% over the last 12 months. Over the last 10 years, up around 36%. We can see it hasn't got back to the all-time highs at the back end of 2021 at $223, now trading for around half that value. It is trading in the mid to lower end of the 52-week range with a double buy rating from Seeking Alpha Wall Street and that hold from Quant. Forward yield 4.7%, P to FFO just under 12. And when we do take a look out of the next 4 quarters, 2 of them they are anticipating to be a decrease, although very marginally. And when we look back, 3 of the last 4 have been at least in line. Good to see it's the previous 4 as well, 75% track record, although they aren't expecting much movement on that FFO estimate, therefore the P to FFO is expected to be unchanged over the next year. In terms of dividend safety, well, it seems to be safe at 76, double undervaluation with around an inflationary increase to the dividend over the last full year. In terms of the key metrics though, like Prologis, they did cut their dividend during the last recession. They had above average growth at negative 6%, but they also underperformed the S&P negative 68. As we can see, it pretty much consistently increasing that dividend around the 4% inflationary rate year on year, and we can see 13 years of consecutively increasing the dividend after they did have to cut it, as we mentioned in that last Great Recession. Then look at this valuation model. Over the last 12 months, every single day, in fact, it has been trading at a severe undervaluation. And this is also reflected when we look at dividend yield theory. That yield is much higher than the 5-year rolling, and the forward P to FO is much lower than the 5-year average of 23.8. We also note real estate, like Realty Income, does sit much higher at 16.3. So let's talk about the payout ratio, where we do see it significantly lower than 90% every single year, 68% over the next 12 months. And when we get to the AFFO, whilst inconsistent considerably, in fact, we do notice long term it is increasing and expected to increase quite significantly over the next year. Then we get to sales growth, where double-digit top line isn't a surprise for this company, something on a consistent basis, although we do notice 2 of the last 10 years have been negative in terms of FFO per growth, last 2 years and next 12 months looking very, very strong, 11%. In terms of numerics though, it has been growing, in fact, around 4 times from 2014 to 2023, and as we've already mentioned, REITs do dilute your position, something that ARE do tend to do as well. Then when we look at the ROIC, around 2% over the last 4 years. Remember, ideally we want to see 3% as a minimum, something to consider. And the margins, whilst a little bit decreasing over longer term, do tend to be fairly consistent around the mid-20s over the last 3 years. Then when we look at the net debt to EBITDA, getting into a bit of a theme today with these REITs, where they are straddling around that maximum 5.5. One thing though, with ARE, it is looking to increase, so definitely consider this in your overall investment thesis. So what about the valuation? $137 is our intrinsic value, 10% at buy at 123, 15% around 116. Now, not at the 20% point, not far off, but for Alexandria REIT, we see around 15 to 20% margin of safety, with Wall Street themselves believing $132 price target, 18% upside. We then move on to Rexford Industrial, with down 6% over the last 12 months. When we look at over the last month itself, down 12%. And over the last 10 years, it has outperformed the S&P, up 184%. It is trading right there towards its 52-week lows, with a double buy and a hold from quant. Forward yield sitting just below the 4% point, P to FFO just above 18. And when we look at the expectations, well, growth every single quarter over the next year, and at a minimum they've been in line over the previous 4, with growth expected to the FFO, lowering the forward P to FFO to 16.7. We also get a very safe dividend score, double severe undervaluation, with a very attractive 9.9% increase to the dividend in February, pretty much following the ways of Prologis. And then when we take a look at their dividend growth, it is something they do take pride in. We see double-digit increases over both the last 5 and the last 10 years, and they've been increasing those dividends for 10 years consecutively. So let's get to this model, which does show us undervaluation today. In fact, every single day over the last year, it has been trading well below its expected intrinsic value. And when we get to the essential dividend yield theory, massive undervaluation, and the forward P to FFO significantly lower than the 5-year rolling, although we do notice it does sit above real estate at 16.3. And remember, some companies do deserve to trade at a premium. It will be up to yourselves to see whether or not you believe this company is worthy of that. So AFFO below 90% again consecutively, 88 in 2023, 81 over the next 12 months. So no worries in terms of being able to pay, and that is why we saw that very safe score. AFFO for the most part also increasing consistently, nice growth expected over the next 12 months. And when we get to the sales growth, even though it has been decreasing, still very good numbers, 18% on a trailing 12 month. Growth on the AFFO looking absolutely phenomenal, one of the best REITs that we have seen when we come to these metrics. And in total sales, no surprises, more than tenfold their top line over the 10 years. Similar to Realty Income though, they do dilute your position at a fairly rapid rate. Now when we talk about this company in terms of ROIC, it has hit 3% for the first time in 2023. So let's just keep an eye on, make sure they can consistently be at the low end, although ideally see it start to increase to the 4 to 5 percentage point. Operating margin, very strong. We see efficiencies in a very good way, 11% to 37 in 2023, 39% on a trailing 12 month. Then we get to net debt to EBITDA, where it is below 5.5, at least for the last 6 years, and expected to increase over the next 12, but still lower than that 5.5 maximum target. So our valuation at around $60 does give a nice MOS today. At 10%, a buy at $54, at 20% around $48, at 30%, pretty much around this level now, not quite yet, but we do notice it is sitting between 25 to 30, with Wall Street liking this company, liking this REIT significantly. Their price target, $56, indicating 30% upside over the next year. As always, do give us your thoughts as we go along these today. We then move on to VICI Properties, where it's up around 9% over the last 12 months. Over the last 5 years, we can see up around 30%. We notice it's trading in the upper end of the 52-week range. Strong buy from Quant, double buy from the other two analysts, although Wall Street pretty much on the fence of a strong buy themselves. Forward yield 5.5%, P to FFO just under 12, and when we take a look at their earnings, they're expecting 3 of the 4 to be negative, consider that, and we see that over the last 4 quarters, 3 of them have been beat 75%, with the more recent 2 being a very marginal beat to the upside. 2.72 FFO, so growth anticipated, lowering the forward P to FO, although marginally, to 11.6. Now, dividend safety, 50, borderline safe, so we can touch upon that. And we will touch upon these valuation models, which show reasonable / slight undervaluation. They increased the dividend 4.2% in line with inflation in September. Now, dividend safety, it was reaffirmed in August this year. What it effectively means is there is a moderate risk of a dividend cut over a full economic cycle. Now, dividend growth, they have been increasing at 10% on average over the last 5 years, with 5 years of consecutively increasing the dividend. So let's get to the first valuation model today, where we do notice whilst it is within the expected fair value, it is trading right at the lower end. And we can also see, based on dividend yield theory, there is that undervaluation, 5.44 above 5.04, and the forward P to FO marginally lower than the 5-year rolling of 14.7. It does also sit significantly lower than real estate's 16.3. Now, when we look at the payout ratio, we do notice it does straddle around the 75% that we want to see. 75 in 23, 75 on a trailing 12-month, 75 anticipated over the next year. Then we get to the AFFO, where it does consistently increase over longer term. No surprises, expected to continue over the next 12 months. And when we look at the sales growth, we can see strong double digit to the top line over the last 4 years, 10% reflected on a trailing 12-month. And we also notice the same to go for their AFFO per share growth, looking good, looking consistent and strong, 11% in 2023, 6% on a trailing 12-month, although a little bit lower than what we want to see on the next 12-month period. So total sales numerically from 2017, it has more than tenfolded, quite significant in that increase. But like Realty Income and others we have reviewed today, they do dilute your position at a very rapid rate. ROIC looking good though, one of the best that we have come across today, well above the minimum 3 to 5%. In fact, 8% in 23, 8% also shown on a trailing 12-month basis. Operating margin also looking very good, very consistent. In fact, 96% on a trailing 12-month is very, very strong. The one thing though that we have to point out with here, and the reason why they got that borderline safe score, for hotel REITs, we want below 3.5. What we can see for VICI Properties, very high, although it has come down from the highs of 2022 to 5.86, even lower on a trailing 12-month, and expected to go even lower over the next 12 months. So it does look like management are improving, so is the balance sheet, so there is something that we can say in positive reflection to that overall dividend safety score. Now, our intrinsic value at just under $40, when we do give it an MOS, 10% a buy at $35. At 20%, it's pretty much around there. We're talking around 50 cents shy, which is very good for a high quality REIT that we not only do like, but also hold in our own portfolio. 20% MOS, 16% upside, $37 price target, and as we saw, you are getting a yield, although it does pay on a quarterly basis above the 5 percentage point. We then move on to NNN REIT, where it's up 14% over the last 12 months. However, over the last 30 days, down more than 8%. Over the last 10 years, up only 14%. Similar to Realty Income, it hasn't recovered from the pre-COVID drop at $58. Right now, it's trading in the midpoint of the 52-week range and a double buy rating. This time, though, the hold is with Wall Street. Forward yield above 5% at 5.35. Forward P to FFO at 13.1. In terms of their expectations, well, 3 of the next 4 quarters expected to be growth, with the more recent one being a negative 2% FFO anticipated drop. And we'd like to see, although very marginal, beats right across the board over the last year, 100% track record. And with December 2025 expecting an FFO increase, we can see the forward P to FFO anticipated to drop marginally to 12.73. Now, dividend does look to be safe, we'll run through these models, but a very mediocre increase, pretty much marginally below inflation at 2.7 this July. In terms of how they performed over the last recession, well, they actually increased the dividend plus 4% growth and also outperformed the S&P negative 44%. But this has continually offered increases pretty much around the inflation rate, so don't expect large double-digit increases with NNN REIT. In terms of years though, they are a dividend aristocrat and they have increased these at 34 years consecutively. Very good to note, one of the best in terms of those years that we have come across today. And over the last 12 months, it has been trading for the vast majority towards the lower end of this expected price. As we can see, it has gone a little bit higher over the last few months. Now it is back towards that lower end, signaling some undervaluation. And that is pretty much confirmed when we see the yield of 5.3 above the rolling of 5, as well as the forward P to FFO, not only below the 5-year 14, but also below real estate's 16.3. So when we look at their payout ratio, consistently below 90%, 68 in 23, 68 over the next 12 months expected. Great sign to see. And bar 2020, where you could excuse it due to COVID, it has been increasing consistently. Expected that again over the next 12 months. So growth isn't a question from that point. And the sales growth also looking good, more than 5 to 10% nearly every single year. And very consistent. Granted, we have that COVID drop that is reflected across all of their metrics. We do notice it does increase by around 2 to 7% on a year-on-year basis, 3% trading 12 month, 2% over the next 12. In terms of numericals, they pretty much doubled their top line from 2014 to 2023, and one of those REITs today, very unlike the others, that does dilute your position at a very slow rate, so that is a good note there for shareholders as well as prospective shareholders. ROIC looking very good as well, very consistent at the upper end, 5 to 6% year on year, in fact been 6% over the last 3 and the trailing 12 months. And when we get to the operating margin, we can see very consistently around the high 50s, low 60s. So what about the net debt to EBITDA? A lot of REITs today have struggled with that, and this company isn't any different. It has increased from the lows of 2014, 5.77 in 23, expected to come down though over the next 12 months, and on a trailing 12-month basis, it is below at 5.3, so not bad at all. No surprises why we get a very high safe dividend score. So in terms of the valuation, ours comes to $53, and that is a nice MOS because at 10%, a buy at $48, at 20%, pretty much around the current price. We're talking a dollar shy, so 20% MOS, around 19% upside from Wall Street with their $51 price target. So is this one that you are looking to buy, hold, or maybe sell? As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to give us your thoughts on each one of these 6 REITs today, whether you are buying the dip. And don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us on the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.